Hi, welcome back to our home. Today, we're going to talk about common retirement plans and their 2023 contribution levels. First, let's start out with some of the most common plans available to you through your employers. That's the 401k and the 403b. 401ks are for employees of for-profit companies, while 403bs are retirement plans for employees of nonprofits like schools, hospitals, and religious organizations. First, these are funded through payroll deductions only, meaning any money that goes into these plans has to go through your payroll first. The money that goes into these plans is part of your gross paycheck. This means that before any taxes are taken out of your paycheck, the money that you are owed on a gross amount is used first to fund these plans. The money inside the plan grows tax deferred, meaning that you don't pay any taxes as the money grows. When you access this money in retirement, the money that comes out of the 401k or 403b in retirement is 100% income taxable. That's federal and state. When can you access this money? Generally, 59.5 is the best benchmark for thinking about having access to this money. Some plans allow their employees to access the money as soon as 55, as long as you've separated from service. If you were to take money out of a 401k or 403b, currently there's a 20% mandatory tax withholding. This means no matter what you take out of the plan, you're always going to have to withhold 20% for federal income tax. 401ks and 403bs are excellent accumulation plans. And what do I mean by that? They're a great way to save money for retirement because in 2023, you can save up to $20,500 into a 401k or 403b. Now, for my friends that are born in 1973 or earlier, you have what they call a catch-up contribution, which means you can put an additional $6,500 away into your 401k or your 403b, bringing your total contribution limit into these plans, if you're over 50, to $27,000. So, as I mentioned earlier, these plans are great ways to accumulate assets. Since they're payroll deducted, that means you can take advantage of something called dollar cost averaging. What dollar cost averaging means is you're taking advantage of the fluctuations in the markets by buying into these programs on a regular, periodic basis. So anytime there's a dip in the market, congratulations, you're automatically buying low. This ability to buy on a periodic basis can give you a huge advantage over the long term. Next, let's talk about the Roth IRA. Anytime you see the word Roth in front of a retirement account, that means that the money that's going into the plan is net of income taxes. This means you use money that you've already paid income tax on to fund these programs. The Roth IRA grows tax deferred, meaning you're not paying any income taxes as the money grows. And when you use the money in retirement, every penny is tax-free. This ability is very unique and can give you a huge advantage for your retirement income planning. You can access the money in a Roth IRA at age 59.5. In 2023, you can contribute up to $6,500 into a Roth IRA. For any of my friends that are born in 1970 or earlier, you can contribute an additional $1,000, bringing your total contribution level to $7,500. Now keep in mind, there are some income limitations on your ability to save into a Roth IRA. If you're a single filer and you make less than $138,000, which is your modified adjusted gross income. Now, modified adjusted gross income means you've taken out all your deductions, and that's the income that you owe taxes on. If it's less than $138,000, you can take full advantage of the Roth IRA. For my joint filers, your modified adjusted gross income has to be less than $218,000. Now, for my single filers, if your income's anywhere between $138,000 and $153,000, you can contribute into the Roth IRA, but at a reduced amount. And for my joint filers, if your modified adjusted gross income is $218,000 to $228,000, then you can contribute a reduced amount into the Roth IRA. For those of us that have incomes over $153,000 for single filers and $228,000 for joint filers, you cannot contribute to the Roth IRA. Traditional IRAs work like the 401k and 403b plan, where the money that goes into a traditional IRA comes off your gross income to help reduce your income taxes. In 2023, just like the Roth IRA, into a traditional IRA, you can contribute $6,500, and if you're over 50, an additional $1,000 to bring up your total to $7,500. A few restrictions on traditional IRAs and contributing to them. If you take advantage of an employer's retirement plan, like that 401k or 403b, your ability to contribute to a traditional IRA might be limited or eliminated. Traditional IRAs offer you access to a universe worth of investments. and they're great options for you when you retire to roll your 401k or 403b into. But that's a topic for another video. So the question you might have is, what's the best plan to take advantage of? Here are some general rules of thumb. First, if your work plan offers you a match, meaning the employer will put in their own money to match what you save, it makes the most sense to at least put enough money in and defer enough of your income to get that match. After you've deferred enough income to get the employer match, next it makes sense to maximize the Roth IRA as long as you're under the income limits. The reason is one, you can save money on taxes now, get your employer match, and then have a good source of tax-free income in retirement. If we've already hit the employer match and you've maxed out your Roth IRA and you're looking for additional retirement savings, next you want to start to max out your 401k or 403b at work. Keep in mind, deferring money into the 401k or 403b reduces your gross income. So that means you owe income tax on less money. So if you find yourself at the end of the year owing money when you do your taxes, adding more money to the 401k or 403b make a lot of sense to help with that problem. If you don't have an employer 401k or a 403b available at work, a traditional IRA is a great way to start saving money for retirement and also reduce your taxes. Keep in mind when we talk about all these different plans, the word taxes keeps coming up. In any situation, it always makes sense to reach out to your CPA or your accountant to help you with any tax questions. If you're looking for a recommendation to one, just let me know. My goal for this video is to help give you a brief idea of what common retirement plans are out there and how much you can save into them. You might have some questions. What plan's right for me? Where should I get started? How much should I save? The next step would be to reach out to me at this email address. I'd be happy to help you answer all those questions. Thank you for watching. I wish you all the best.